Good morning. Thank you for joining us for today's coffee talk, growing customer deposits profitably. A couple of things. One, obviously, when you think of quick rate and growing deposits, traditionally it's been in the wholesale market. But as you probably saw from the announcement a couple of weeks ago, Quick Rate has been acquired by Infusion Marketing, and really the Infusion's business is helping financial institutions grow their retail deposits and loans. And so you can start to see and understand why we're excited about the transaction that's occurred. Certainly over the coming months, we're going to do more to introduce you to all of what Infusion does. But thought we'd start today with a coffee talk presented by Tim Keith, the CEO of Infusion, and Dan Marks, the president of Infusion. Just again, tell you a little bit about what they do, and hopefully you be able to begin to see why we're tremendously excited about this new chapter in the future of Quick Rate. Just a reminder, we want you to communicate with us through today's presentation. As with other coffee talks, certainly submit any questions you have through the Q&A box or the chat feature, and we'll monitor those through the presentation and either take them in the midst of the presentation or at the end. We will have a link to the recording and follow up with that and a copy of the slides for all the participants here today. So without any further ado, I'd like to introduce you to Tim Keith, the CEO of Infusion Marketing, who's going to tell you a little bit about Infusion and how they can assist you and your financial institution with growing deposits profitably. Tim?
Excellent. Hello, everybody. Thank you for this opportunity to meet all of you and to talk about deposits. Obviously a hot subject over the last 2 or 3 years since the rate cycle started. I'm going to stop my video and share my screen, and let's see if I can do this successfully. Can everyone see my screen now?
Yes, you can, Tim.
Fantastic. So a little background on Infusion. Infusion was founded, it'll be 17 years in December. We have worked with around 400 community financial institutions over that period. Our heritage really goes back almost 30 years to a predecessor company called Infusion Marketing Group. If you add that in, it's hundreds and hundreds of institutions over nearly 30 years. Our strategy team, as well as our leadership team, including Dan and myself, have held senior positions in, I believe it's 14 different financial institutions. Dan and I worked together at First Horizon in senior level positions there, and Dan most recently was Chief Marketing Officer of Hancock Whitney Bank. So we are bankers. We speak your language. We've sat in your chair. We've dealt with all the challenges you guys deal with, whether that's the limits of the core systems or the compliance environment and everything else. We just went over 18 billion in deposits and loans generated through our pay for performance programs, and that is growing at a very rapid clip. We expect to exceed 20 billion sometime this fall. So with that as a way of introduction, and just to put a finer point as we transition to the deposit conversation, one of my particular experiences was at First Tennessee, First Horizon, being responsible for our deposit portfolios during the 2004 to 2007 cycle. In that cycle, we had 14 consecutive Fed meetings with rate increases. And so kind of lived through that, pricing our products in 3 very different markets. And in our particular case, we were aggressively growing our mortgage footprint without growing our funding footprint. And so it created some unique liquidity challenges in the context of a rising rate cycle. So I've definitely lived a lot of what you have gone through over the last 2 or 3 years as a banker in that cycle. And so we'll relate some of that as we talk through this content. So I want to take a step back in thinking about what we would call sustainable deposit growth and lay out really a simple concept, which is that any successful sales process, including the process of selling deposits, requires two things. The person you're selling to must have the means to buy the product, and they must have at least some inclination to buy the product. And you have to really have both to be successful. And so if you think about your lending environments and what you guys deal with every day, this is fundamental to that process. Every one of you has customers who badly need credit, so they have a high propensity to borrow. But if they have a 580 FICO score, they have no capacity to borrow. You're not able to make them a loan. Every one of you also has customers with perfect credit. They own their home outright. They could borrow substantial amounts of money from you. So they have massive amounts of capacity, but they have absolutely no need for a loan. So they lack propensity. So you're not going to sell them credit either. So the whole process of lending is rooted in the relative capacity of a borrower to borrow at a point in time with their end market status. So there are capacity and propensity indicators all through your customer data files, not just for lending, but for deposit gathering, transactional behaviors, digital behaviors. Some of those are institutional. They really like you a lot. Some of them are category specific. They've demonstrated a preference for banking in certain ways. So as we go through here, we're going to talk about specific to deposit gathering. What are these predictors of capacity and propensity that we can leverage so that we can grow in a sustainable way in terms of our margins, in terms of our ability to retain the funding that we attract. So for years, when I presented this slide on the left, all I had was capacity propensity.
Hey, Tim,
Yes.
excuse me. I don't know if your slides are moving. We're still on the perspective slide. So you may have to start the slideshow.
Yeah, let me, thank you.
Mhm.
Let's see. Why don't I do this?
Yep, there we go. It moved to that. Yes.
Okay. Yeah, I'm going to stay in this mode. So
Okay.
I assume that's still large enough for everybody to see.
Yes, the slideshow will be bigger, but yeah, this works.
Yeah, great. Fantastic. Sometimes that does that with Zoom, so I apologize for that. So for years, when I presented this slide on the left, I just had capacity and propensity, kind of laying out this basic concept. As our business, the business of banking, has become a digital business, I've added the word awareness over here on the left. Obviously, even before the pandemic, we had given customers technology to manage their accounts. They don't have to come to branches as frequently. The pandemic forced even most of the holdouts to adopt digital behaviors. And at the same time, all of that is happening, the transformation of our business into a digital business. We have this growing plethora of online lending and online savings providers that we have to compete against. These are generally low friction, well-priced alternatives to what we have to offer. So to go back to the lending example, you may have a customer who's a good credit risk. They're in the market, let's say, for a home improvement loan. They generally think favorably of you, but if you're not top of mind with them, they get hooked into an online lending provider. Before you know it, that need has already been met. You miss that opportunity to meet that need, which not only is a lost opportunity, but could put the rest of the relationship at risk. So our concept today is, if we can take data, identify these capacity propensity predictors in the data, act on them by creating awareness of what we have to offer, that's a formula for growing deposits in a sustainable way. But that formula is not driven by price. It's not driven by large scale campaigns. It's a discipline to apply that process on a consistent basis. And that's really what we're going to talk about today. These concentric circles, by the way, represent our sources of income. As retail bankers, we buy deposits from depositors, hopefully as cost efficiently as we can buy them. We sell loans to borrowers while we manage risk. We generate fees from transactors while we manage our servicing expenses. So all of you have broad segments of customers who produce income in each of these three categories. And the overlap of these circles is essentially a picture of relationship banking, customers that produce multiple types of income for the institution. When you get a customer in the center of these circles where you're meeting not only their deposit or savings need, but also their transactional need and their lending need, these are deeply rooted relationships. And so they tend to buy based on trust, history, relationship. They're not going to move their deposits over a 25 basis point difference on a CD, because the reason they're banking with you is much deeper than that sort of pure price proposition. So relational relationally rooted growth is the growth that's going to allow you to shift from price-driven deposit growth to more sustainable growth. And so that's kind of foundational to what we'll talk about today. So did that just transition when I switched to that next slide?
Yes.
Okay, fantastic. Okay, so these are some guiding principles to efficient deposit growth. And the first one here is obvious, but it's foundational. So we need to say it, which is there's a trade-off between volume and margin. Every one of you knows if you put a high enough price out there, you can attract deposit dollars. The challenge is, of course, the higher the price point, the lower your growth, the lower your net interest margin, and the more difficult it is to hold on to that funding over time because you're attracting rate sensitive dollars that are willing to move for better pricing and downstream. So our challenge as bankers is always to match up my volume need at a point in time with the most efficient cost of funds scenario available at that time. It's easy to say that, but the hard part is, well, how do I determine what my most efficient cost of funds scenario is on August 1st versus October 1st versus March 31st? And that's what we're going to talk about today. So having lived through a rising rate cycle as a banker, one of the first things that happen when rates start to go up is our finance folks develop almost a paranoia about repricing risk. And that's understandable, especially in this cycle, because we had an historic amount of money pile up during the pandemic in checking and savings, low cost of funds, liquid accounts. And so when rates start to go up, especially as aggressively as they have in this cycle, our first instinct is let's try to preserve as much of that funding in those low cost of funds buckets as we can. The problem with that scenario is, and what happens, by the way, is, so we say, in order to preserve and try to limit repricing and disintermediation, we're going to only make our best pricing available for new money. And again, you can make a very logical case for that on the surface. The problem with that is new money buyers have lower propensity to bring you deposits versus people who've already trusted you with their deposits previously. And so the more that I'm selling deposits or buying deposits from low propensity buyers, the more I have to use rate to make up for the lack of propensity. The more I'm gathering deposits from high propensity buyers, the less I have to use rate to gather those deposits versus relationship expansion and leveraging trust and history and so forth. So number three, we think about a spectrum where propensity to buy intersects with rate pricing to optimize volume versus profitability. So again, the more that I am gathering deposits on the high propensity end of that spectrum, the less I have to use rate. The more I'm gathering deposits on the low end of that propensity spectrum, I have to make up for the lack of propensity by using price. Simple concept. So then if you take what's the implication of that? Well, the implication of that is if you want to grow deposits in a meaningful way from a volume perspective, yet grow deposits from cost efficiently from a cost of funds perspective, you've got to be willing to take some repricing risk because people that have already given you your money are your high propensity buyers. And so it's not that we ignore that risk, it's that we understand it, we measure it, we take it into account versus just taking a caveman approach and saying new money good, repricing bad, and not putting any actual data behind it. And we don't have the luxury of doing that. And I would say this too, we've never seen a rate curve as steep as what we've seen the last 2 years historically. And so one of the byproducts of that is the aggressive nature of the series of rate increases that we had has created a greater risk of overpricing just because of the elasticity that's built into that curve. And so, if you think about how deposits are priced in many cases, contrasted with loans, on the loan side, we're pricing down to the basis point based on very specific credit risk metrics, asset quality, these sort of things. With deposits, a lot of it is what are they paying down the street. So I was with a client recently. We were on a second floor conference room looking out the window, and they were pointing to a competitor down the street. And they were saying, oh, we like competing with these guys. They're not very smart. So after the meeting, we go downstairs and we're in the branch, and there's a branch poster for a unique combination of CD rate and term. And I said, oh, how did you come up with that combination of rate and term? And they said, well, we just match what they're doing down the street. And I said, well, I thought you said they're not very smart. But we know this is the case. A lot of deposit pricing is set based on what our competitors are paying, which is a circular process that tends to reinforce overpaying on rates. Let's use data to price our products versus just matching what our competitors are doing. So we're going to talk a lot about that. So in that process, number 5 here, the single most consistent thing I've seen in 35 years of deposit work, both as a banker and working with almost 400 banks and credit unions, is the more they have with you, the more they have somewhere else. We see this consistently showing up in tracking of campaigns and various forms of analytics. And I'm going to give you an anecdote in a few minutes to demonstrate that point as we get deeper into the presentation. So obviously we can't grow a single dollar of deposits until we retain the ones we already have. So retention is fundamental to a deposit growth strategy. And one of our premises is, waiting till a customer has a foot out the door to try to drag a foot back in the door is very inefficient. From a deposit perspective, you end up just matching pricing from competitors where you have really no choice. The best way to do retention is to prevent the foot from going out the door in the first place. And the best way to do that is to proactively address a wider range of needs within those relationships, 6 months, 12 months, 18 months prior, so the foot never gets out the door in the first place. Okay, so it's great to have principles, right? And to have kind of guiding principles for how we want to go about a particular strategy. But a principle is not worth anything if you can't put it into action. So where do we start in terms of putting these principles into action? And obviously, you can't have a plan to go from point A to point B without an accurate understanding of where point A is in the first place. All of you have probably had this experience that I have at least once a month when I'm traveling, where I get to an airport and pull up Uber, and I'm trying to get an Uber to go wherever I'm going, and Uber can't accurately locate where I am. And I know I'm never going to get in that Uber, and I'm never going to start the journey from that airport to my destination until they accurately find me. And similarly, you guys are not going to be able to build a plan from where you are today to where you need to be from a funding perspective, whether that's, the volume of funding or the profitability of your funding. You're never going to be able to develop an effective plan unless you have an accurate, realistic assessment of where you're starting from. And so benchmarking, I think, is always valuable. In my experience of 30 years of doing it, it's never been more valuable than it is today to compare your key metrics to peers and accurately assess what's my starting point here in terms of managing my deposit portfolio, getting the growth I need, getting the profitability I need out of that, out of my funding sources. But again, a benchmark analysis without a plan is also not very helpful. Sometimes you can look at reports that are really interesting and they have important data, but when you ask yourself, what would I do about it? It's kind of hard to figure out. So a good benchmark analysis has a projectable plan that is projectable in dollars and accounts, a pro forma, essentially, projection. But even that is not worth anything unless you can act on the plan. And right now, sometimes we have to act when we're not 100%. Maybe we're 80 or 90%, which makes tracking even more important than it's ever been. Being able to really stay on top of where are consumers and businesses when we put particular product and price propositions in front of them, and how is what we're seeing in our tracking compared to what peers are seeing who may be putting slightly different propositions in front of their customers. And so this is process on the right here. OA is opportunity assessment. That's our benchmark. That's a jumping off point for planning. Then we execute, we track, we adjust and execute again. And ultimately we come back and ask ourselves, are these activities moving the needle? And so it's that complete loop, that's that discipline I talked about earlier, taking data, identifying opportunities, act on them, measuring the impact of our actions and adjusting course. That's our process at Infusion that we work against every day with folks like yourself. And we bring into that process not only what you're seeing in your results, but also what your peers are seeing as they're executing against similar opportunities in their data. So I'm going to take each one of these elements and drill into it a little bit further, and I'm going to start with benchmarking. So what are the key questions you should be asking yourself in assessing opportunities for deposit growth? Well, number one goes back to an issue that was brought to the fore with SVB Bank's failure over a year ago, and that's deposit concentration. Deposit concentration has been fundamental to every balance sheet of every bank and credit union in the country for years and years. But again, it got elevated to the front pages of not just the industry press, but the Wall Street Journal and other press, because it was a key factor in SVB's failure. What's fascinating, because we look at these concentration ratios every day for a wide range of institutions that we work with, we know concentration is fundamental to every balance sheet because it's the 80-20 rule, but you might be surprised how much it varies from institution to institution. You see pretty significant standard deviations in these ratios. And so it's critical for you to understand, do 4% of my households control 60% of my deposits, or is it 2% that control 70%, or is it 10% that control 55%? You need to understand these ratios. It's critical to the basic structure of your profitability. And then, of course, the question becomes, okay, if 4% control 60%, how strong are my relationships with that 4% of households? How reliable are those funding sources? And so there are particular ways to answer those questions that we'll get into on the next couple of slides. Number two, single service usage is really important to understand what percentage of my households in each deposit category only use one service with me. So I'm only meeting their transactional need, or I'm only meeting their savings need, or they only have a CD with me. What does that tell me about my ability to cross-sell because they only have one service? But also, what does that tell me about attrition risk? Because single service depositors are more likely to move their money around than households that have multiple services where I'm meeting multiple needs within that relationship. Another category that's really interesting to look at is new households. How many deposit dollars did I attract from brand new relationships in the last 12 months? And what are the mix of those deposits, checking, savings, CDs, compared to my peers during that same period? And one specific question is, if I take my year-over-year deposit growth from a consumer deposit perspective, let's say, what percentage of my year-over-year growth came from new relationships versus wallet share expansion of pre-existing relationships? I had a client recently where 146% of their year-to-year deposit growth came from new households. That's a little scary. That means if they had attracted about half the number of new relationships, they would have been down significantly in deposits. That's an indication of what they're doing is price-driven, where they're going after new money because they don't want to reprice, but they're getting thin margin rate shoppers in. And if they didn't have those, they would be down. We don't want to be in that scenario where we're dependent on, thin price new household rate shoppers, because we get constant pressure there. We're on that George Jetson treadmill at the end of the Jetsons where, Jane, get me off this crazy thing. None of us wants to be there. And so understanding where you are today and having a realistic view of where have my deposits been coming from is a starting point of building an alternative plan that might be more sustainable where you're not on that treadmill. One of the missed opportunities for a lot of institutions is underfunded accounts. So we think about, okay, I got to grow deposits. We need to go out and generate some new account activity. And that's generally going to be true. But all that assumes that the accounts we already have are funded to the level of the capacity of the account holder. And that's never the case 100% of the time with any institution, including yours. So when you look at particularly liquid categories like checking and money market savings, there are ways to use data to identify populations where, let's say, their checking balance is $3,500, but everyone else that looks like them has a $35,000 checking balance. So how do I get them to fund up to that level of that cohort? In the case of money market, they have a money market savings, but their balance is in your bottom tier of your product when the data says it could be in the top tier. How do I get that fund up to the level of their capacity from an outreach perspective? That's a super efficient way to grow deposit dollars because the account's already open. You already have a tiered product that rewards the customer based on their balance. Let's identify those people and let's start promoting that added value you have to offer within that product. Accounts per household can be deceiving. Wells Fargo demonstrated that for all of us a few years ago, but it is helpful sometimes in assessing where I have gaps in terms of relationships that could have 5, 6, 7, 8 accounts, but they only have one or two, and it helps us to quantify those gaps. And then, to me, the essence of relationship banking is where I'm meeting both the transactional as well as a lending need. So where do I have opportunities to grow checking within my lending base, which, by the way, not only gives me quality checking, but it becomes the bridge from the current loan to the next loan. A mortgage household that has a checking with you is 2 to 3 times more likely to subsequently do a home equity on that same product. For those of you who do auto lending, if I have a 5-year auto loan and I have a checking account and I pay off that loan, the chances I'm going to do another auto loan with you are greater than if I don't have a checking account, because the checking is the bridge from one loan to the next. So there's a lot of important reasons to sell checking accounts to borrowers beyond just the checking itself. So we want to understand where we benchmark out there and where quantify where we have opportunities and gaps to sell into. So just a couple of examples of an opportunity assessment based on the last 2 slides. We'll start with deposit concentration. I love this view of the data because it does a great job of intersecting a balance sheet view with a customer relationship view. A lot of banks, including the ones I worked for, talk a good game about relationship banking, but at the end of the day, it's ALCO is the tail that wags the dog. We believe strongly you don't have to choose between managing portfolios and managing relationships. You can do both at the same time, but to do it, it's really helpful to be able to bring key data points together in an integrated type of way. And that's what this table does. So on the left here, we have 6 ranges of deposits from $1 to 250,000 plus. You have the number of relationships that have that level of deposits with the institution, the deposits and percentage of deposits controlled, the percentage with checking accounts, the average checking balance, the percentage that only have one service versus multiple services, and the percentage that have credit with the institution. A lot of very rich, both portfolio and relational data kind of brought together. And then you see a series of indexes interspersed throughout this table. So one of the things that Infusion brings to the partnership with QuickRate is very deep normative data sets. So our national norm is a set of statistics on how consumers and businesses are using retail banking products. It's built on more than 10 billion data points. It's updated every day with fresh data we're taking in, which are essentially core data dumps from wide range of institutions all across the country. It's strictly community financial institutions, so no large banks. And so what that allows us to do is to take an individual client's data, like what you're seeing on the screen here, and run a whole series of statistics against that data, and then compare those to their peer group at the point in time. And so in doing that, we use an indexing system where an index of 100 is equal to the average bank or equal to the average credit union. And so an index of 120 would be 20% above the average peer. The index of 80 would be 20% below. So with this particular table, one of the things we do is take the top 4 rows, which would be 10,000 or more in deposits with your institution. We aggregate that in this bottom row here. So for this client, they have 3,000 households that have 10,000 or more with them. That's 36% of their depositors. They control just under 300 million or 96% of deposits. So that 96% of deposits controlled is an index of 99. So that's normal because an index of 100 is norm. So it's normal to have 96% of your deposits controlled by high depositors. But having 36% of deposits in that segment is 12% below norm. So anytime you have a lower percentage of depositors controlling a normal percentage of deposits, you have more concentration than norm. If this 35% was 45%, they would be above norm in terms of percentage of households, which would mean they have less concentration. But here they have a more narrow base of funding for a normative set of funding, which means they have higher concentration. So we all know we have concentration. Now this institution knows they have higher concentration. But again, we go back to that question, well, how strong are my relationships with this 36% that control essentially all of my deposits, 96% of deposits? So we would answer that question in three really fundamental ways. Do we have their core checking? Do they have one service or multiple services with us? And do they have credit with us? Credit's an anchor on the deposit. So if we go across the bottom here, out of the 3,006 high deposit households, they have 2,500 that are single that have checking, which is 84%. That's an index of 102. That's great. They're above norm by 2%. But when you start to go up by tier, that index to norm declines and the absolute value declines with each tier. In the very top tier, only 70% of their households have checking, which is 8% below peer. They're also below peer in the next tier down. And you look at these average balances, 169,000, 76,000, 41,000. So, one of our unique challenges right now is after having a historic amount of dollars piling up into checking accounts during the pandemic with the liquidity events we had, just when we thought we would always be liquid and all this money sitting in all these non-interest and nominal interest rate buckets, all of a sudden we have spiking inflation and we have this historic rising rate cycle. In the last 12 to 18 months, we've seen a historic migration back out of checking into a more traditional mix of savings products. And so if we want to try to retain some semblance of checking as a component of our funding mix, we have to grow accounts. And if I'm going to spend $1 of marketing to grow checking, I want to start in these top tiers where when I'm successful, two important things happen. I get high balance accounts. So it takes 10 $4,000 checking accounts to equal the funding impact of one $40,000 checking account. So I get high balance accounts, but I also get prioritized retention benefits. When I sell a checking to these high deposit households without checking, I get high balance accounts, but I also protect relationships that are critical to my funding base. So that's $1 I want to spend every day of the week on marketing. And that type of targeting is something your next best product models are not designed to pick up on. We go after those opportunities for clients on a pay for performance basis. So we're going to go after them. We're going to pay for everything. And you're only going to pay for accounts that come in the door as part of marketing campaigns. Single service, this is where you don't want to be above norm because that means you have a higher percentage of households that only use one service with the institution. And you can see they're 30% above norm in all these top tiers. So we want to get these folks into a second service, a third service, a fourth service, because single service households are more likely to move their dollars in multi-service. And then credit, again, is an anchor on the deposit. You can see high depositors don't use credit as frequently as low depositors because they have a lower propensity to borrow, but they still do use credit. And home equity is a great product in these top tiers because they tend to have high property values and chunks of lendable equity. So when I sell a home equity line of credit to one of these households that has 50 to 100,000 in deposits, first of all, I get high quality assets. They got 40,000 in their checking, they're paying their home equity on time. But second of all, it puts a multi-year anchor on that deposit. If I sell them a home equity line, that next 10 years are very unlikely to move their checking account. And so anytime I can spend $1 to grow loans, in this case, home equity, and I get A, high performing assets, and B, prioritize retention benefits. Again, I want to prioritize that investment over any other investment in growing loans because of that combination of benefits. So what we have the ability to do then is to take these high deposit households and take this more balance sheet type macro view into a product view and look at, I'll go here, look at a distribution of accounts and balances. So, you've got 2,500 of them have checking with an average balance of $42,000. Even the non-interest checking balances are 36,000. So again, if I'm going to grow checking, let's start here with the households that don't have checking. Also, from a practical perspective, sometimes the simplest math is the best math. This particular client has 2,500 high deposit checking households. They have 316 that have money market. So when you subtract, you've got 2,200 high deposit checking households, most of whom are transacting, but who by definition don't have a money market. The ones that do have a money market have $123,000 average balance. So if I want to grow money market savings, let's start with these high deposit checking, and the ones that are using debit cards and in my app every week. Those are propensity indicators. They're engaged with my brand because they're using my plastic. They're in my app. They're going to bring me money market dollars where I don't have to use promo rates. I can just promote the fact that I have a tiered product where the more you deposit, the more I can pay you, and B, that when you open a money market, you can transfer money back and forth between your checking and your money market. And given that most of these checking households already have online banking, it's an easy, you're really selling that flexibility, liquidity feature versus pure rate. It's a classic example of how to grow deposits without promoting rates by leveraging all the investment you've got made into getting these checking relationships in the first place. Now, you might say, well, aren't they just going to move this $40,000 checking into their money market? They will move some of it in the short term, but our experience is high deposit checking households want to have a minimum amount of money in their checking behaviorally. So we see that money, whatever money gets moved in the short term, gets moved back into checking from outside the bank or credit union over the next 30 or 60 days once they have an opportunity to move that money around, and you end up with a substantial percentage of what you generate in the money market cross-sell is coming from outside, especially when you're not using rate pricing, you're using liquidity flexibility to attract the money. In fact, when you promote, if you promoted a 4.5% promo rate to these households, you would actually see more repricing because you're incenting more of that. Now, I want to go back here to single service households. So we looked at high deposit. We also want to look at households that only use one service. So I'll point out two things here in terms of simple prioritization for retention and cross-sell. For retention, this client has about 450 households between savings and money market that are single service, which means they only have a savings or they only have a money market, no checking, no CD, no loan. And when you add the balances together, it's about $12 million in deposits. So that's money that we'd rather not have to replace with more expensive money. These are 450 households. We know who they are. Let's cross-sell them checking accounts to anchor those savings and money market dollars where we don't have to go replace them with more expensive CD money. Simple retention prioritization. This is where we've seen the biggest negative impacts on retention are these single service liquid savings categories. We had a client up in New England where they actually had $100 million in single service savings coming out of the pandemic. And that had been static for 4 or 5 years. The first year of the rising rate cycle, that dropped from 100 million to 80 million. They lost 20 million in deposits. And it was basically people who were priced at 0% for the 3 years of the pandemic are now seeing competing offers out there at 5%. And they have limited loyalty because they only have that one service. So they're moving the money to get better pricing. We want to give them a reason to stay by proactively meeting a wider range of their financial needs. Now, here's one other thing I'll point out from a cross-sell perspective. This client has 4,100 single service checking households with an average balance in checking of $12,000. 400 of those are interest checking with average balance of $35,000. These are people that have money somewhere else. If I only have a checking with you and I got 30,000 in that checking, I got a lot of money somewhere else. So let's leverage that checking, not just, so that's a capacity indicator. They got capacity for more deposits, but also to the extent that they're using debit cards and online banking, those are propensity indicators. So that's where you combine capacity and propensity indicators to define a target audience for very efficient deposit growth, where we're not have to use rates to get our growth. So again, you can take that to a gap analysis on product, where, for example, we can look at money market savings penetration. It's a really classic example here where this client is twice the norm on CD penetration of their high depositors, but they're 20% below norm on checking penetration and 63% below norm on money market. Those are quantifiable gaps to go after to increase money market and checking, to balance out my funding where I'm not so CD heavy through targeted, proactive, continual, always on outreach. So those are just a few screenshots on how you assess opportunity. But again, assessing opportunity is really not worth anything if you don't have an action plan. And so one of our mantras is the most effective digital marketing starts with the audience, not the channel. So rather than saying, how do I want to use social media? Let's ask the question, who should I be talking to about deposits, and how can I go find them in online environments? So this is an example where we did our assessment. We went through a whole series of screenshots like I showed you and a whole bunch of others, and we identified these audiences. 3,800 new to bank households, 10,200 high deposit households without checking, about 15,000 high deposit checking households where we don't have a CD, or 11,000 where we don't have a money market, business households with propensity for checking, and so forth. So these are discrete audiences. We know who they are. These are subjects we want to talk to them about: checking, CDs, money markets, lending. This is a schedule of communication across a set of months. It's always on. If you take one of these pixels in one of these boxes, which these boxes represent campaigns, a pixel would be a relevant message put in front of a customer at a point in time about their financial life and what we have to offer them. And so we're measuring that interaction throughout these campaigns: impressions, clicks, opened accounts. And at the end of each of these boxes, we're doing a deep dive review: how many accounts were open, what was the response rate, what was the funding level, how much was new versus repriced, what else did they open, and how did all of that compare to peers who were doing similar activities during that same period. So I talked about our national norm database just a second ago. We have a separate database of campaign tracking results. It's built off 100 million marketing contacts. It's also updated every day with fresh campaign results we're getting in for a wide range of institutions, bank and credit union. So that keeps our finger on the pulse of what's working, what's not working, and particularly how to set deposit pricing to get the volume you need without overpay. So we have the ability to take these types of quantities in these different discrete segments and subsegments, dump them into the tracking database and say, based on a calendar of outreach like this, channel mix, frequency, and product offer, and so forth, what would be the number of accounts generated where we have open dates in the campaign and the product promoted by households targeted. So they're targeted, they open an account during the campaign, and the account that's opened is in the product category promoted. What are the balances in those accounts as of the end of the campaigns aggregated across that calendar? So here we've got 24 million in checking, 132 million in other deposits, 100 million in loans. And so these are responses to campaigns for a calendar like this. Then we have what we call halo balances. So that's where we use the primary offer, like checking account offer, to get the customer into a discussion with one of our salesperson. They buy the checking, but then they also buy something else. That may be a savings account, that may be a credit card or something else. Those are not considered responses to a campaign because we weren't promoting those other products, but they were product sales opportunities enabled by engagement with the primary opportunity. We assess contribution by taking the promoted product balance times the net interest margin assumption. That's either the individual client's FTP rates or round number assumptions we're making on net interest margin. And that allows us to calculate return on investment. For what it's worth, again, we just went over 18 billion in results, and our accuracy rate is running about 104% actual to projected. It's going to transition into our last segment here, which is action planning. So what are some key considerations and then some examples of actual client results? So the virtues of modest pricing. Obviously, more modest, data-driven pricing versus the blunt instrument of high rate pricing gives you better short-term margins. It also creates less downstream stress on retention. If I sell a 12-month CD at 425 instead of 525, it's easier to retain in 12 months because the expectation of what the go-to rate is going to be is fundamentally different. Number three, this is kind of counterintuitive in one way. More modest pricing results in a higher percent new money. Now, more aggressive pricing generates more total money, but more aggressive pricing wakes up more of your own customers who basically say, okay, if you're going to pay me 5.5%, I'll move the money. At 4% or 4.5%, I might not have woken up. So you wake up more of your own customers when you're more aggressive with your pricing. And we see this consistently. And I got an example I'll show you in a minute. You do want to provide your best customers a reason to stay without unduly waking up sleeping sleepers. We need sleeping sleepers to stay asleep. That's fundamental to our ability to drive net interest margin. But those that are going to leave, if we don't give them an alternative, we want to be able to give them an alternative. And so that's the balance we want to strike. Also, when you promote more aggressive pricing, especially on CDs, you are literally incenting customers to concentrate their dollars in individual buckets that you have to deal with downstream versus having more laddering or more dispersion of dollars across category. Number two here, especially with where we are right now in the rate cycle and the potential for rate cuts over the next 3, 6, 12, 18 months, it's a great time to trade off flexibility and liquidity for top line yield. And so we'll talk about a couple of ways to do that and show you some examples of where we're doing that for clients. So I spoke recently at the Massachusetts Bankers CFO Forum, and was making the point to the CFOs in the room that you could have the greatest ALCO meeting in the history of ALCO meetings. You could high five as you're walking out of the room. We just nailed our rate strategy. You can put that rate strategy on every rate card in every desk drawer of every branch. But if no one sees that rate card, it does not affect your portfolio. And so as our business has become a digital business, marketing has become our rate card. It's the vehicle through which we have to communicate what we have to offer. So if we're not doing proactive marketing of deposits, it's going to be harder to be able to make a strategy work in terms of being able to push dollars into categories and price points that we want to push them in and get the growth we need and the volume we need to fund our balance sheet. Onboarding new customers is not just about getting them to activate debit cards and sign up for online banking and mobile banking. It's also an excellent opportunity for deposit wallet share growth without using rate offers. Just better engagement creates more capture of wallet share in the first 90 to 120 days of a customer's relationship without having to promote rate propositions. We put all this together in this final statement. The most sustainable growth strategies are the base hit strategy. Get a base hit every day instead of trying to hit a home run 3 or 4 times a year. Home run strategies almost always rely on aggressive rate pricing versus meeting customers where they are day in, day out with relevant messages about their financial life. So these are 3 campaigns that were in market together at the same time. You have the more aggressive 539 12-month, 512 any term, and then 475 11-month. And obviously you have a higher response rate and more volume generated with a more aggressive price. Now these are 3 different size institutions, so the response rate gives you a little bit of an adjustment there. So you have half the response rate at 475 versus 539, but you still have a good response rate. But here's the thing, with the more aggressive price, only 38% of the money generated was brand new versus 56% at 412 versus 96% at 475. We see this showing up consistently where the efforts to generate new money and put more aggressive pricing out there end up not doing what you're trying to do, where more modest pricing, the higher percentage of the money is new. Plus, 11 months from now, it's easier to hold on to 475 versus 539 money. And so you see that NIM benefit of $75,000 by having more modest pricing. And of course, the question becomes, is $12 million enough to fund what I need to fund? And that's where we've got to be able to run these scenarios on these discrete segments to determine, back to one of my earlier points, what's the most efficient cost of fund scenario available based on the volume I need at this point in time. And these sort of data points give us the ability to answer that question in very specific, discrete terms. This is a good example where a client offered 4%, 4.07 on a choice of 7 and 15-month terms. This is a bank with 6 or 8 branches, something like that. They generated $30 million in 90 days. 69% was new. So 20 million was new, 30% was repriced. 32% of responders also bought but something besides a CD. And so this is a modest price, 4% at these terms, but they still got good volume, a good percent new money, and 32% bought something else. But we asked the question, okay, 69% new money is not bad, but what if we wanted 100% new money at a similar volume? What would we have to pay? And the data told us, this is just pure letting the data tell us. The data said, instead of 4.07, you have to offer 475. You'll end up getting 37 million instead of 30. But here's the problem. That additional 68 basis points of top line rate, even when you subtract the 31% repricing cost on the top scenario, you still end up spending $50,000 more in interest expense, because you can overcome that additional 68 basis points. So that you're outsmarting yourself to get 100% new money, great. But you just spent $50,000 more to do that, because that 68 basis points you had to pay to get the new money is a real financial cost. So I said earlier, the more they have with you, the more they have somewhere else. This is, again, based on 100 million marketing contacts, response rate by amount of deposits on a CD cross-sell campaign, amount of deposits pre-campaign. Households that had $50,000 with the client pre-campaign averaged a 7% response rate versus a 2% for 10 to 50 versus a 1% for less than 10. So less than 10 is where theoretically you're going to get all the new money, right? Well, unfortunately, first of all, they don't respond, 1% versus 7%. Second of all, when they do, the average balance is 8,000 versus 50,000. So again, the more they have with you, the more they have somewhere else. They're more likely to buy a CD when you promote it and bring you another $50,000. This demonstrates that they're not just moving money that they already had, they're bringing you another 50. And so they're more responsive and they bring you bigger chunks versus people with less than 10 who are less responsive and bring you small chunks. And so you want to be able to measure not only what I generate in CDs, but how much of it's new versus how much of it is from inside came from inside the bank or credit union. Case study here, and I'll do this quickly because I know we're running out of time. So the last few slides are really quick. This is a client that needed funding during the 2017-2018 rising rate cycle we had. They were going to match their largest competitor at 225 on a money market promo rate. We convinced them based on the data to offer 175 instead of 225. I projected 35 million in money market balances at 70% new money. We got 34.5 at 76% new money, pretty accurate, and actually came out higher on total new money generated. Saved 50 basis points on 35 million. Do the math. It's real savings. And when that rate expires, a lot easier to hold on to 175 money than it is 225. This is Pinnacle Bank in Nashville. You can see it's a digital campaign with also a direct mail component to it. We tested, by the way, a picture of one of their bankers versus the actual rate. Of course, the rate beat the bankers. No offense to his hairdo there. Some other examples, just to give you a flavor of the types of campaigns we're talking about here. This is Fidelity in Kansas. And you can see the foliage. This was a fall of 2022. In their core market of Kansas, 3% on a 12-month. That's 150 basis points below Fed funds at that time. In their growth market of Oklahoma, 350. This campaign did $20 million, even at those modest price points. Credit union, this is United Nations Credit Union. We offered, they were going to offer 525 on a 12-month in the spring of 23, so a year ago. We convinced them to do 450 instead of 525. We saved 75 basis points, still generated 20 million more than we projected. And you can see these are digital campaigns. So these are not, we don't use cookies. We're not buying lists on Facebook. We're taking these audiences that I showed you earlier from this calendar, and we're matching files of these audiences to these digital channels and only talking to people who match these channels on social media, paid display, email, and so forth. This would be a different credit union, United. Again, very modest pricing. 9-month, 415. You see the branding very different between these institutions, so it has to be brand centric. This was a Harbor One Bank in Boston, where we're using a combo where we have a longer term CD combined with a money market savings. 35% of households who were targeted who bought one of these products bought both. So we get this great combination effect where we're getting over a third of the audience is buying both the liquid account and the longer term CD. This is pick your term, where you're trading off flexibility. Hey, 450 is our rate. You choose a combination of terms, and so you're giving flexibility. You're actually encouraging laddering, which disperses your dollars versus and avoids concentration in individual promoted terms. Other considerations as we wrap up in the last couple minutes here, debit card campaigns obviously drive fee income, but they also correlate with increased checking balances. And we track that very closely. And that could be $1,500 per responder in increased checking balances versus non-responders, because I got to have more money if I'm going to start transacting. And so it's a great way not only to get more fee income, but also to grow checking balances as debit card marketing campaigns. One way to reduce deposit concentration is to promote your planned savings tools to lower deposit households, to encourage them to build their nest egg. To the extent that you create a upward escalator from lower deposit levels to higher, spread your deposit funding across a wider base. And it's a great thing to do for the customer to help them, encourage them to build their nest egg. And then business savings is a category of opportunity where, as rates have gone up, business owners, and I can tell you this firsthand, having been through this with my bankers, they want to be paid and market level yield on their excess funding. And some clients don't want to have that conversation. And so it's an opportunity for those that do to meet that savings need for that business. I'm going to skip over this and go to here. This was an example of a debit card campaign where responders increased their deposits by 5,600 versus non-responders who showed runoff of 2,900 during the same period. Just shows you this is higher than normal, but it's pretty dramatic in terms of the point of the campaign is to generate fees, but we're actually getting deposit lift as a key byproduct. So my takeaways here as we wrap up is there's never been a better time to do benchmarking than there is right now with everything that's happened over the last 3 to 4 years. The digitization of our business should make marketing a more fundamental and critical component of your growth strategy than it's ever been, because in many ways, marketing is the only way we have to initiate a conversation with a customer that would not happen otherwise. Marketing that is not financially accountable can't live up to that challenge, however. So you've got to have that financial accountability in terms of not just how many widgets did I generate, but what are the balance impacts, new versus reprice money, halo effects, and how does all of that compare to what peers are seeing? So you put all this together, the discipline to act on opportunities as they present themselves in your data files it's what's going to separate winners from losers among community financial institutions who have to compete with large banks in the future. So one of the things we're offering is, now that we are a combined company, Infusion Quick Rate, is we normally charge for our opportunity assessment analysis. We're offering it no charge for clients of Quick Rate. It's a 40-page document with the deposit concentration, high deposit households, single service households, new households, all these views. We compare your markets to each other in your total. I come and present this assessment to your leadership team in person, and there'll be no charge and no obligation. It's a very robust, beyond marketing, give you your product strengths and weaknesses, your pricing, gaps, your sales effectiveness metrics. And so if you're interested, you can respond through the chat, or respond to the meeting notice, let Sean know, and we will talk to you about what we would need to be able to do the assessment. So I love the opportunity to do this for all of you. And apologize for going over a little bit, but happy to answer any questions as well.
Thanks, Tim. And just a reminder, we had a question come in. Will a copy of the slides be available? Yes, there'll be a follow-up email in the next day or two with a copy of the slides and a link to the recording. So certainly be on the lookout for that. And if you registered, all the attendees will get that. We also had a question just about existing customers. Will the new relationship with Infusion, affect anything, your ongoing agreements and things of that nature? No. What we really anticipate is hopefully no, changes in experience, that you've always come to deal with Quick Rate. So, we're excited about, as Tim pointed out, this is a very adjacent business to what we're doing, but it's not, exactly, wholesale funding. So no, we anticipate all of your experience with Quick Rate, the marketplace, quick analytics, and telecredit to remain the same. Okay, we do have thank Lizzie for the interest in an opportunity assessment. So we'll follow up with you about that, as well as Dean. So thank you both for responding through the chat. We will certainly reach out to you on the opportunity assessment. Any additional questions? Go ahead and submit those now. Otherwise, again, be on the lookout for the email with a link to the recording and a copy of the slides. Certainly reach out, as Tim indicated, to any of us here at Quick Rate or Infusion. And this is really, again, just a starting point to, again, introduce you to what Infusion can do, but also be, an opportunity just to continually educate you on how we believe the new combined organization can assist your funding needs, both, again, in your retail markets and in the wholesale markets. So, we're really excited about the partnership going forward. Tim, any oh, thanks, Matt. We will get to you as well. Any final comments before we let everyone back to their day?
No, I just appreciate everybody's time to listen to this, and I hope it's been valuable and instructive, just a way of thinking about things, and just super excited about the future of our combined companies. We think a lot alike, and the ability to combine the data assets I talked about with the very rich data assets that Quick Rate, Quick Analytics has is super, super exciting. So a lot more to come there. Thanks, everyone, and enjoy the rest of your week.
Great. Thanks, Tim. Thanks, Dan, for joining us. Thanks to all of you for attending. Be on the lookout for an email. And again, we'll continue to reach out and try to, again, bring you more information, both about Quick Rate and Infusion going forward. Thanks so much and have a great week.